Walgreens is down 65% in the past 5 years, and in this video we are going to look at recent news, the financials, the balance sheet, the dividend, and finally determine what is a good price to pay for Walgreens using my Excel spreadsheet. Starting with recent news, the CEO and CFO of Walgreens have stepped down, which looks a bit scary, and this is why the stock is down mainly. However, in my opinion, this does not affect the fundamentals of the business, and the uncertainty of the management team is a short-term issue. Regarding their last earnings report, they beat on revenue and missed on EPS. But talking about EPS, if we take a look at what analysts are expecting, they are expecting Walgreens to make $6.2 per share in 2027. If you assign a 10 PE to this company, which is low, it would make it a $62 stock in 2027, which is a plus 181% gain, which is a lot of upside. Last news that I want to cover is theft, which has hit retail hard on profits. I think that this is a temporary problem and that they are going to resolve this issue in all retail. Moving on to their financials, revenue is growing slightly but nothing very exciting, as this is a well-established business with not a lot of growth potential. If we take a look at segmented results, US retail pharmacy, the largest part of their business, is increasing sales although gross profit is slightly down. Then the international segment is growing faster. And finally, US healthcare, which is a new part of their business, is also growing fast, although it is a small percentage of their revenue. I am showing you this in order to demonstrate that fundamentals basically remain the same. Margins have been down recently, which could be due to their competition and theft. But again, I think this is temporary. Then, to calculate what price to pay for Walgreens, I used my Excel spreadsheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis and did low, middle, and high assumptions. For revenue growth, I went with 2, 4, and 6 because although analysts are expecting a bit more growth, I wanted to be conservative. For their margins, I think that this last year was a fluke year for free cash flow and net income. So I went a bit lower than normal margins again to be conservative, and I assumed 1.75%, although you are seeing 2 but Excel just rounds it up, 2.25% and 3%. For P and price to free cash flow, I went with 12, 14 and 16. And for my desired annual return, because you can get around 9 or 10% investing in an ETF, if you take the risk of investing in an individual stock, you should desire a higher return. I usually go for 10, 12, and 14, but because I feel that there are more risks with this company, I went with 11, 13, and 15 to have more margin of safety. And as you can see, it's all green. There are 6 numbers. The top 3 are based on profit margin and the bottom ones on free cash flow. In this case, they are the same because I assumed the same on profit margin and free cash flow margin. These numbers mean 2 things. One, that these are the prices you should pay in order to make the desired return that I have put in. Secondly, if the low assumptions occur, you are going to make a 20% return on your money annually over the next 7 years, including dividends. If the middle assumptions occur, 30%, and if the high assumptions occur, 42%. So there is a lot of upside potential. I also want to mention that the Excel spreadsheet does not take into account the balance sheet. So let's quickly take a look at it. Walgreens has $970 million in cash and $36 billion in debt. This is a lot of debt, and if it was another company, I would be worried about it. However, in the case of Walgreens, this does not worry me because they have a lot of leases. It has very expensive leases because it wants prime real estate locations. Before giving my conclusion on the company, I want to talk about the dividend. The dividend yield is very high at 8.73%. Dividends come from free cash flow, and although I think this has been a fluke year regarding free cash flow, and I think it's going to get back to normal levels, I think this dividend might get cut because it eats out a large amount of their free cash flow. So if you invest in this company just because of the dividend, You should take that into account. In conclusion, although I think there are some risks with this company, such as competition, uncertainty in the management team, and overall issues with the industry, I also think there is a lot of upside potential. Therefore, I think the risk reward is worth it, and I bought the stock when it dipped. However, do not buy or sell because of anything I said. This is not financial advice, and you should do your own research. I hope you enjoyed the analysis, and I'll see you on the next one.